Good afternoon, everyone, and welcome to our event today on business succession and exit planning for financial planning and advice businesses. A pretty interesting and important topic at the moment. Let me just update you and give you some background, industry information, etc., and then we can get into the body of the presentation. I'm going to cover off on two key areas today. Firstly, key trends in financial planning, and then specifically looking at succession and exit planning for financial planners as it applies in Australia, and some of the things that we've seen work particularly well in the industry and things that need to be worked through going forward to make sure business owners are well prepared for the most possible successful exit. Let's look at some key trends to start with. A couple of things around the industry at a glance and some stats to look at. Obviously, significant impact over the last couple of years with the various inquiries and changes in legislation. True to say, most investors have a reduction or a lack of confidence in the industry, and that's negatively affected revenue. There has been a decline in revenue across the board. I'll show you some of those numbers in a moment to have a look at as well. Here's the top line data. Certainly you can see annual growth over the last 5 years reduced by 2.5%. But the good news is it's projected to grow by 0.7% over the next 5 years. The number of businesses declined slightly, but still quite profitable. So there are some good high-end top-line figures for the businesses to look at. Just need to be aware of the trends and issues that are happening within and around the industry in the current environment. Certainly, obviously, you would all know the future of financial advice reforms, the Royal Commission, changes in rules around delivery of service, grandfathered revenues, commissions on products, and the upgraded, if you like, for want of a much better word, service requirements all have an impact on the industry and the business. And we've also seen some significant changes in ownership structures when large banks and so on exited their wealth businesses or sold them off, etc. So lots of change going on. That's the important underlying message, and I don't think it's all finished yet. There's still lots more to happen, but hopefully it's starting to enter into a period of some sort of stability going forward, so people are fairly confident. As I've already said, significant effect of those changes, SMSF's growth and continuing to grow, a little bit of confidence gap, I guess, or a revenue gap as well as a result of that. Profitability, I guess it will fall initially, but that's largely based on price competition. I don't think that's a good way to run the business or focus on it. It's certainly an issue. Price competitiveness in this business is obvious, but there's also some other industry competition that's going to come into play over the future in terms of things like robo-advice, etc. And certainly new professional standards. However, I think the longer term view for the industry is certainly more positive. Most of the things that have been implemented are good news for the industry and for its employees and also for clients longer term. So we'll see how that pans out over time. A bit of a SWOT analysis. Generally speaking and historically, certainly high profit businesses, low customer concentration, as in a wide number of customers across most businesses, low product concentration, and low capital intensity. Obviously, personnel and labour being the key issues in these businesses, and we're going to talk a lot more about that in a moment. Threats to growth, both long-term and short-term. In terms of a breakdown, product and services segmentation, I won't read all these out to you. You can obviously all see those on the screen. I don't think anything too surprising there, and not changed dramatically over the last 5 years either. So that's a significant change as well. Next thing to have a look at then is the major market players across the industry. Certainly a large number of small players, and obviously $4.7 billion revenue. A few larger players on the right-hand side there with Commonwealth Bank, IOOF and AMP. But a large number of much smaller players sharing the bulk of that business industry revenue. Geographically, no surprises either. Fairly evenly spread in terms of pretty much the demographic spread of the population. Nothing unusual or outstanding here. the business spread basically matches the spread that you get from the existing population. Let's have a look at industry performance numbers and just see what we can sort of work out here. Certainly, key external drivers, high income. The All Ords Index is still a key index driver. Markets drive financial advice. Certainly been some challenges very recently as a result of COVID with the increased volatility in the markets. And then obviously we've got an aging baby boomer population and we have a large number of people retiring. It's about 5,000 people a week in Australia turning 65 at the moment. And so there's an ongoing requirement for detailed retirement planning and advice for those people that will still drive demand for some time going forward. Changing environment has affected the performance over the past 5 years. This graph just shows you that performance, mapping the revenue out. You can see a strong decline, 2013, 14, 15, and now starting to recover. The good news is the view is that that'll recover and actually increase into the future. Not massive growth, but reasonably consistent, stable growth going forward. Couple of key things to look at. This is a very heavily regulated industry, in fact, more heavily regulated than most others, and that has increased and I believe will continue to increase. So there's an issue there around managing that regulatory reporting compliance requirement because it all costs money, and that's a significant issue for most planning businesses going forward as well. Higher standards, not necessarily a negative, but it is a threat. So compliance with all of the new legislation that's come in has really been an issue. There's a lot of changes going on in and around this space, particularly in terms of competition. Key success factors for financial planning businesses, communication, compliance, loyal customer base, obviously market research, and then qualified workforce. Now, those requirements have been strengthened recently with the changes in legislation, but I think the overwhelming, I guess, success factor has got to be that people understand that providing financial advice is a profession the same as accounting or law. I don't think we're there yet, but we're getting closer to it, and certainly that's the thrust of the government push over the last 12 to 18 months has been to head down that path and strengthen that presence. Let's talk now about succession and exits generally, and then we'll talk specifically about some of the things that we've seen work particularly well in financial planning firms. Bit of an overview. The first thing to understand is the demographic that's driving this whole thing, and that's the baby boomer generation. The first baby boomer in Australia turned 65 in 2011, and they're still increasing that birth rate. If you have a look at that graph, the birth rate of baby boomers turning 65 continues to grow until it slows down, not until 2029. So we're still 9 years away from the peak, and then we start to see that birth rate decline. It's a strong, steady growth curve. We're only halfway through it. As I said earlier, there's sort of 5,000 odd people turning 65 every week here in Australia. That is a long, steady supply-demand curve, and that's something that everybody needs to be aware of. It will continue to drive growth, particularly in advice around aged care and retirement, etc. Interestingly, and it's something we need to really understand, most business owners still depend on their business to fund retirement. In most of the research, it talks about the fact that for people that own a business, anything up to 90% of their entire wealth is either in the business or in assets related to the business. So it may well be in a property, but often that property is secured against lending to the business. So a bit of a mixed bag of intertwined wealth, particularly focused in and around the business, which makes the extraction of that value on retirement very, very important for business owners to achieve. And that's what we're going to focus on today. According to KPMG, only 35% of Australian businesses have a succession plan in place. In our experience, that's probably overstating it. Most people have not done the work required to prepare for or document or implement a business succession plan for their practice, and that's equally true of financial planners, accountants and lawyers. Even professionals who probably should know better have done nothing about the succession planning aspects. No such thing as planning too early. I've never heard anyone say, I wish I started this later. The key issue is the later you leave the starting point, the more you reduce the options available to you. There are several exit planning options that take several years to implement. Gradual sell downs, management buyouts, employee share plans all happen over an extended period of time. And simply, if you leave that too late, it's no longer available to you as an option. So the key is to make sure you start that early. Let's have a look at some of the demographics and concepts around succession planning. This is a quote from Conrad Travers, who we do a lot of work with, talking about succession planning actively being a key part of business owners' plans to ensure they maximise the value they've created. Most people go into business to earn income, but they also go into business to build an equity value. And Conrad here is talking about the fact that that plan actively should be part of what you're doing to maximise wealth or the value you've created in your business, and then to work out the best way possible to extract that wealth when it comes time for you to exit and or retire. Three key areas of focus. In terms of succession and exit planning, there's three things that business owners really need to get right. That is, the business itself needs to be well prepared. And that does include financially. So the business needs to be well run. It needs to be not dependent on you. It needs to be financially profitable, have systems and processes in place, etc. Your financials, your family's financials also need to be ready. And it's quite amazing to me sometimes how badly prepared business owners are in terms of their financial position. Structures, ownership of assets, super, all those things are a substantial issue and a barrier to successfully achieving an exit. And lastly, personally, the business owner themselves need to be ready. That's a bit of psychology, a bit of social, and a bit of, changing the heavy focus that business owners have on being part of the business for such a long period of time. There's actually a school of academic thought around a thing called role identity fusion, which means that the business owner's identity is so closely fused to the role that it's quite a difficult thing and quite a traumatic thing sometimes to actually be able to separate the business owner from the business, because they've been in it and part of it for such a long period of time. The way that we do that is to work through a 21-step process. There's a couple of things I wanted to point out here, including an opportunity for financial planners to work in this space. I've often said that I think it's almost an issue of neglect when financial planners are working with business owners who may well fill out a fact find and put on the fact find under assets something like privately held shares or shares in a private company, $2 million, and the financial planner can't get involved in that or can't work on that with the client. It's probably one of their major assets. So the opportunity is to have a look at that privately held business and how well prepared is it for exit? Is it actually worth $2 million? What are the risks attached to that asset? And more importantly, are the risks that are attached to that asset likely to impact upon the other assets and therefore the overall financial plan? The other important thing to point out amongst this 21-step process is you will see a number of the steps, particularly around 4, 5, and then again at 18, 19, 20, 21, are actually heavily dependent on financial planning advice. Step 4 is financial planning, working with the clients on their asset protection structures, on their ownership of various assets, self-managed super, etc. And then again, right at the end of the process, when we get down to a liquidity event, there's some capital gains tax planning at step 17, which often requires financial planning advice. And then again, 19, 20 and 21 are all about investment planning, asset protection, estate planning, wills, etc. So lots of involvement there. It's a very collaborative discipline. It's not something that an accountant can do on their own, or a planner or a lawyer. It's actually very collaborative across a number of different advice spaces to make sure you get the best possible outcome. A couple of key decision factors, or a couple of key questions that business owners need to sit down and think about, both personally, but also with the other stakeholders, which is often family members, sometimes it's employees, maybe you've got other shareholders in your business as well. Timing, when are you thinking of exiting? Are there any employees that are interested in taking over, both from a management succession point of view and also an ownership succession point of view? What's the business look like financially? How well prepared is the business? Has it got cash reserves? Is it structured appropriately? do the owners need the extraction of equity or the sale of equity to fund retirement? Is that absolutely critical for you? And then what are the growth opportunities going forward? If we're talking to a buyer, it's always good to show them the opportunity to grow the business going forward. And then how willing is the owner to accept the terms of the exit? Is the owner actually ready and prepared and happy to sell at a particular point in time? Exit options. Just having a look at the various options available to business owners, whether you're a financial planning business or any other business owner, the options are the same, but they change specifically depending on the preparation, the time and the effort that's available to you. Right at the bottom left, simple, quick, cheap and easy, and cheap's an important point there. Family, friends and fools, selling your database or your client list is generally speaking not the best way to maximise value. As you go up and to the right, the opportunities become far more complicated. They take longer, they require more effort, there's generally more risk, but you maximise sale price. Somewhere in the middle of that diagram is a sweet spot for financial planners. Now that could be partial sale, management buy-in, employee share plan, trade sale, which means sale to a competitor. And perhaps if you're larger, you could get private equity or venture capital involved. Though for most of the businesses that we deal with, that's probably not appropriate because they're not of a significant scale or size to do that. Let's talk about employee share ownership plans. We're seeing in professional services firms, including financial planning practices where we do a lot of work, employee share ownership plans becoming far more popular as a succession planning tool. Let's have a look at some of the theory behind that, and then I'm happy to answer some questions as well. The first part of it is around a ladder to equity. This is a great quote from Warren Buffett talking about providing a ladder for employees to transition from income to equity and ultimately to control of the business over a period of time. But we have to provide that ladder. We have to design a structured mechanism for them to be able to do that. And the structured mechanism is simply, normally, a transition from income into performance-based income, which is commission or bonus-based, then to a profit share, which typically requires them to be more involved in the business, then to equity, which is typically an employee share plan, and finally the last step, which may never happen with some employees, is a transition into control. Let's talk through those steps and just examine the strengths and weaknesses of each, because it is actually quite important. The first one is income, and most employees start there and generally finish there. It's turning up and getting paid. Now, that sounds very derogatory. It's not meant to be. That model has been around for many hundreds of years and it works very well. But there's no performance focus, and there's certainly no business focus, and there's certainly no long-term focus or loyalty around that. So what we do is move people across this ladder or up these steps over a period of time. The second step, which is still called income, but it's about enhanced income. It's about income based on performance. So you'll see lots of businesses introduce income with commissions, or salespeople are typically paid, real estate agents, for example, typically paid a very low retainer or salary, $40,000, $50,000, and then most of their additional income comes from bonuses or commissions on sales. That works quite well, but there's two negative points around that income model. The first one is it's individual performance only, which is sort of okay, but it's not about team. Secondly, it can create quite siloed behaviour, and often you will see people that are paid on commission competing with each other within the same business, or even worse, starting to do things like getting to the end of the month and holding some sales over to next month because they know they're not going to make their bonus this month, or bringing sales forward, discounting. All those things become problems in that particular income model. So if we want to fine tune the way that we pay our employees, my very strong view is employees behave based on how they're paid. And so if you want to improve that income model, you should go to a profit share model. We've got several clients that are focused on this right now. The profit share by definition includes two key things that the other two can't or don't. The first one is profit means total. That means revenue and expenses. So now we've got employees starting to think about and be concerned about expenses within the business. The other thing is that it requires a team approach, because if I do really well this month, but the person sitting opposite me does really poorly, then the profit will be impacted. So it requires much more of a team-based approach to the business, to customer service, to clients, etc. So that generally brings about significant improvements in performance. The next step on the ladder then is to go to equity. Now, the big difference between profit share and equity, there's two. The first one is time. When you give people equity, or if you think about property investment or investment into the share market or most other asset classes, the big advantage of equity ownership is long-term appreciation in value, capital gain in other words. You don't have that ability in any of the income models. It doesn't matter how you do them, you simply can't grow an asset based on any of those income models. The other thing that equity gives you is a time frame. People that are making decisions about building equity generally think much further into the future. They're not thinking short-term quarterly performance or monthly or even this financial year. They're generally thinking long-term equity ownership and building that equity over a period of time. Employee share plans sit under that space. The last one is control, often not used because generally speaking, we're not handing over control until we're actually ready to retire, but it's a significant exit barrier for most business owners. If you cannot prove that someone else can manage your business for you without you being there day to day to override every decision, then you significantly decrease the valuation, and that's a problem for most business owners. Now, in terms of employee share plans themselves, they give you certainty of exit. So there's a documented process around selling down, and there's a funding mechanism that goes with that. And I'll show you an example of how that works in a moment. They generally deliver improvements in financial performance, certainly see improvements in employee retention, productivity and profitability. You'll generally get a much better chance of the business continuing successfully after the owner exits. And you'll also allow a tax-effective transfer of ownership. There are significant tax concessions for employee share plans here in Australia. Key thing about employee share plans, they're quite strategic. And as I said in the introduction, they do take time. So it's important to understand that you need to start this process early. You'll see some of the stats there talking about improvements, and it's not just about the business being better off, it's also employees. You'll see there, employees typically earn 5 to 12% more than non-employee share plan owners. They build up assets over a longer period of time, etc. Let's have a look at an example of how an employee share plan works, and we can talk through what needs to be done in terms of the structure. You'll see there the original company sitting on the left-hand side there. We introduce underneath that a peak performance trust, which is a separate legal entity. It's actually a unit trust, and we invite our employees to join that on the basis that we're giving them an equity-based reward and encouraging them to think and act like business owners. The only thing that peak performance trust, which is the share plan right in the middle of the diagram, is allowed to do is buy shares in the parent company. And so it's a forced savings vehicle. We'll talk about how it works in a bit more detail, but the overall idea is it's a separate legal structure. It's owned by our employees, and the only thing it's allowed to do is buy shares in the business. Now, how does it work? Firstly, we generally fund it by a profit share model. And that's because often we have employees within our business who are quite good employees, but who don't have the financial capacity to write a check to buy shares. But they do have the capacity to contribute in terms of performance and use that improved performance to fund their acquisition of shares in the employee share plan. Of course, the funding can vary. You can also have employees writing a check, drawing down their home loan. We've even got in some services, and particularly in financial planning, it's possible Macquarie Bank has lent to the employee share plan to acquire shares on behalf of those employees. So it is possible to fund that through debt or through the employees, and there are even some rules around salary sacrifice. The funding's quite flexible. Bottom line is you can use a profit share plan, which was step 3 of our ladder to equity, to use that to fund step 4, which is the purchase of equity. Over time, the profit gets paid into the peak performance trust. That money is used to acquire shares, and the company's revalued every year. So those employees are seeing the improvement along with the original owners. Because we now own shares in the company exactly the same as our employees, our interests are much better aligned around profitability and performance of the business and overall growth of the equity over a period of time. Let's have a look at an example. On the left-hand side, we've got our shareholders, John and Jane, who own Smith Trading, which might be our financial planning company. We've benchmarked the business on the top right-hand side, and we've said that the business typically makes a profit of $500,000. So that's going to be our benchmark. Below that number, nothing happens, which is quite important. Over that number, however, we've agreed we're going to share 20% of the profit to the employee share plan. So in our example, we get to the end of the year, we've made $600,000. There's $100,000 excess. 20% of that physically gets paid down the bottom left-hand side. A check gets paid from Smith Trading across to the employee share plan. Importantly, that's a tax deduction to the business, but it's not income into the hands of the employee share plan, and it's deferred income for up to 15 years for the employee. So there are some tax concessions that make that quite tax effective in terms of how we do that. The only thing the employee share plan is allowed to do, as I said, is buy shares in Smith Trading, and the only place that it can buy those shares is from John and Jane, who sell down their shares to the employee share plan. So gradually that cycle continues until either one of two things happens. We reach a cap, so we might have agreed we're going to sell 20% of the equity to employees, as lots of my clients do, or we've got several clients also that are selling the entire business to the employee share plan. So they will just continue to make contributions like that until they get to the point where the employee share plan now owns 100% of Smith Trading and owns the business. So that can be quite a tax effective way for that plan to work, and important to understand a couple of key things about how the plans work. Obviously, you have to be an employee to be involved. So if you leave, you're automatically disqualified. And there's generally a disqualifying discount that applies. So if you leave early, then you get penalised. It's a great way to drive employee engagement. It's a self-funding mechanism. We're buying equity gradually. So it's a good way for owners to gradually exit the business. If you want to sell and get out between now and Christmas 2020, that's not the way to do it. But if employees can gradually buy in, the owner can gradually sell down and also gradually extract themselves from the day-to-day operations of the business, it can be a very, very effective, pre-documented exit strategy that works for both parties. And it also works, importantly, I often talk about win-win-win. It works well for employees because they can gradually buy in over time. It works well for the owner because they're gradually extracting themselves day-to-day from working, but also from equity. And it should be a good win for the business as well, because it preserves the business, the client relationships, customer service, etc., to make sure the business is successful going forward. Now I'm going to have a break and just ask for any questions. If you haven't used Teams before, there is a little chat box where you can type in questions. I'll have a look at those. I'm also happy for you to ask them out loud if we need to. Yeah, we've got a couple of questions coming up. Okay, the first one is, how long does it take to implement? Yeah, that's a fairly common question around employee share plans. They need to be implemented reasonably slowly. When I say that, that's 3 or 4 months, not 3 or 4 years. And that's really around the 3 stages that need to happen. Firstly, you need to have a valuation of the business. So you need to know what the value is for. That's required under the tax law. Secondly, you need to do some education for employees around being in the employee share plan. What does it look like in terms of taxation? What does it look like in terms of franking dividends, credits, owning equity? Some employees haven't been involved in that before in a private company, so they need to understand that. But also the ownership mindset training around what does it actually mean to become a business owner in this particular space. And that can be quite an education piece. The third phase of it then is just the legal documentation, legal agreements, trust deed, letters of invitation to employees, there's an employee manual, etc. So generally takes about 3 months. The next question I'm going to answer straight away around what does it cost over the 3 months. It's generally a $20,000 exercise with a few disbursements around $2,000 on top of that. So if you said 20 to 25,000 as a total budgeted cost for the entire plan, you'd be fine with that. It certainly does give you then what you need in terms of an exit strategy, but it's fairly good value in terms of the staff turnover issue as well. If you look at the research now, somewhere between 35 and 40% of an employee's salary is what it costs to replace them in terms of recruitment fees, training, lost productivity, etc. Any other questions before we wrap things up? Okay, Yeah, okay, so good question there around the size of business that these employee share plans are applicable for. Look, I've got several of these plans that operate with one employee, so you don't need to have a massive number of employees in the practice. It's not required that. I've got a number of businesses that have set them up to lock in, retain and reward one employee within the business. So it can certainly work. And look, I don't think you need to worry about the size of the business. I've got clients that are turning over a couple of $100,000 using this as a gradual sell down strategy because it works. I've also got clients, we've got clients that've got 100 employees and 40 of them are in the employee share plan. So it can work at both ends of the scale, but I don't think there's a minimum size. Next question from Jason. Have you seen a financial planning business full sale via an ESOP? If so, how long typically between implementing and full sale? Yep. So you can actually design the employee share plan, and one of the design parameters is around how quickly it operates. The example we looked at before, 20% of the profit above $500,000 will obviously take some time to gradually buy that business over a period of time. If we change those rules and said we're going to pay in 50% of everything over $250,000, that share plan would obviously work much more quickly. Generally speaking, in small to medium businesses, including financial planning practices, because I've actually done quite a few employee share plans for financial planners, to sell the business, 100% of the business, it's probably anywhere between 3 and 7 years to implement that over a period of time. It probably could be done slightly faster, though not much faster than 3, and it certainly could be done slow. I've got a couple of clients who are planning it out over a 10-year cycle. So typically, Jason, between 3 and 7 years to implement. Any other questions before we wrap things up? I'm happy to answer questions now. I'm also happy for people to contact me directly if there are other questions, certainly for you to email me. There's a lot of information, including a white paper, which hopefully most of you have got around the employee share plan option and exit planning for financial planners. But if there are other questions, I'm happy to answer them now and or separately. I hope that's been a useful and informative session for you. If you do need more information, please go to the website or email me directly. My email is just cwest@successionplus.com.au. Hope that's been helpful. The session's been recorded and we will publish a recording for all attendees so you can go back through any of the material if you need to. Thank you for joining us, and I look forward to catching up with you again soon.